Fed chairmen are speaking out about inflation and how to fight it. And today we're going to go over whether that information is already worked into the rates, or will we be seeing big rate hikes in the future. That article and several other articles on today's Real Estate Daily. Hello everyone, my name is Troy, and every day we go over the housing, real estate, and the mortgage markets. We go over all the pertinent articles for it. Now, before we jump into it, let's go ahead and hit that subscribe button. We definitely would appreciate that. We are growing the channel. I'm pretty proud, but we want to give you the best 5 minutes in real estate on a daily basis. Also, if you like the content, hit that like button. It gets the YouTube algorithm going, and more people get to see this. So, first article here. Now, we're at the last day of August, so I'm getting ready to see some of the new August numbers coming in September. We've seen such dreary information on real estate numbers in July. We knew that because in most, half of July at least, it was, a holiday that showed up on a weekend. So the first 4 or 5 days, actually the first 10 days, no one really worked. Personally, that's what I saw out there. So the numbers were dreary, but we do see at the end of July and now in all of August, things have really picked up back in the real estate market. We've seen multiple offers come back, but the Fed is making a point. Everyone last week said, Fed Chair Powell's 8-minute speech was very hawkish. He's been saying the same thing every single time. Now, it's just the way he says it and the tone he says it that some people have, and some analysts out there have taken it a different way. And we did see the market, the crypto market as well as stock market, pump a little bit, last month. But now we're kind of seeing this hawkish idea. And again, I can't, iterate, I should say, over and over that they're going to they're focused on the same exact thing, and they keep saying the same exact thing over and over. This is from CNBC. It says Fed Mester sees benchmark rate above 4% and no cuts at least through 2023. They're not pivoting, guys. They're not pivoting. If we go back historically 40 years ago, we saw the Fed chairman at the time, he raised rates to 20%. We're at 2.5 to 2.25. We're not even close. And the numbers that keep coming in on a month-to-month basis are strong numbers. Our economy is way overheated and way too strong. But she's continuing, this Cleveland Fed chairman, Loretta Mester, keeps coming out and saying the same thing. They want to get the CPI number at 2%. They want to get inflation under control. It's right now not under control. It's being manipulated, absolutely. And when manipulation slows down and stops, it's just going to continue to rise. So she sees it. She has absolutely come out today and said, again, reiterate what the Fed has been saying all along. Next article, it says, prices are clearly increasing at a slower rate. Housing market cools from April's peak, led by Seattle, San Francisco, and San Diego. And we know this because on the West Coast, we're seeing the greatest values year over year going up, and we're seeing average home prices. Look here in Orange County, it's $1 million the average home price. San Diego's in the 800,000s. LA County is 850,000. It just can't keep going that hot. It can't continue to be that hot, and especially now because there's less inventory on the market. West Coast always is where it starts, then it makes its way through the United States. We just see a slower rate, absolutely, in July. But I have a feeling that the numbers are going to pick up a little bit here, and we're going to see really strong and steady valuations throughout August. Next article. How do we know that the market and the inflation is going to stay strong? Again, we keep seeing this over and over. Private payrolls grew by just 132,000 jobs in April. ADP says it reworked jobs report. Guys, let's be very honest. You can spin this article any which way you want, CNBC. The bottom line is we keep adding more jobs into our economy. It's not like we're taking it away. There's no subtraction here. There's addition. Now, you could spin it that, and let's read the key points. It says private payrolls grew by 132,000 for the month. A deceleration from 268 gain in July. Wow. We keep gaining more and more. It doesn't matter if it's 250,000 or it's 132,000. We're gaining it. This is not good for inflation. It only means more people have more money. More money means I spend more. That means that the more demand there is for products such as gasoline or even food or electronics, whatever it is, it just means they're going to go up because there's more demand for it. Now, if the supply can meet that demand, that's fantastic. But if the supply cannot meet that demand, we're just going to see inflation and it will accelerate. Next article here. And this is one that, again, it's a way you spin it. I hate that CNBC has just got this negative tone in here. But it says mortgage demand falls even further as rates shoot back up to July highs. Why is mortgage demand falls even further? Well, mortgage demand is falling either further year to year is because last year there were refis and this year there was no refis. So it doesn't say that whatsoever. Let's look at the key points here again of what this article is about. It says the average contract, let me highlight it right here. There we go. The average contract interest rate for 30-year fixed mortgages with conforming loan balances, which is $647,200, increased by 5.8% last week from 5.65 the previous week. There's more mortgage demand week upon week upon week, but if you look at it year to year, we have no refis out there. So it's going to be down. Of course it's going to be down. Spin it like it is. We're seeing an increase in mortgage demand. Why? Because we're going to see an increase in sales in August. I've been saying this over and over. It's just the way they want to spin it, and they're trying to spin it negatively. If any of you are out there in the crypto industry, you'll see influencers out there saying the housing market's crashing. Why? Because they read foolish, and I don't want to say deceptive articles like this, but they do, and I see it all the time. In fact, let's jump to our next article, which has been kind of talked about amongst a lot of people out there. It says Goldman Sachs anticipates housing market growth to slow sharply. Guys, it's slowing sharply because there's less inventory. How much can I say that? I don't hear anyone talking about it. What I do hear is Goldman Sachs says there's a housing recession. If there was a housing recession, then we would see property values plummet more or greater than what the houses were purchased 12 months ago. We're not even close to those numbers. We're seeing every month, we've seen an increase over year to year numbers. It's ridiculous. If a recession means we're going down, we're less than the year before. We're not even close in a housing market recession. We're not close to last year's values when people bought properties. I'm not going to say everyone has gotten property appreciation, but I'll say this much. The average is over 15% year over year. So let's not over exaggerate this thing and again have deceptive practices. And the last I'm going to talk about here is mortgage rates themselves. It says 30-year conforming is 5.8, really stayed unchanged. 15-year conforming bumped down about 5 basis points, but 30-year FHA fell a little bit there, a 0.03. So we're seeing things kind of they're just flat right now. But whatever you think out there, if you're on the sidelines, it is foolish to think that I'm going to wait for a housing crash. That is about the foolish thing I've heard. Why? We're at all-time high rents, and every month we keep reaching another all-time high. I am a landlord, and every month and every 12 months, when my tenants' leases are up, I am raising their rent. And I'm going to raise it to the fullest or what the market is and slightly above the market. So before you're out there thinking, oh yeah, I can, I'm going to rent for a year, you are burning your money and you're going to deal with guys like me who are investors looking for their best returns and not looking out for renters. That is how it works. Until you get that through in your minds, you can sit on the sideline and you can burn your money. Or the alternative is you can get out there, look for a home, buy a home, and for the next 30 years, I can keep that same mortgage payment. Or if I'm smart, Fannie Mae, like we went over an article last week, Fannie Mae has said that next year sometime, when they think that the Fed is going to pivot, that we're going to see rates in the low 4s and high 3s. Buy my home today, then I can refi back then. or refi in a year from now. At least that's what Fannie Mae is saying. Think about it. If you're thinking about waiting till rates go to 4.3%, what's happening at that point? You got it. Everybody else is out there looking for homes because the cheaper the money is, the more people are out there buying houses because they know their rents are going up and they will not tolerate, having, year over year 5-10% jumps in their mortgage, in their rental payments. Guys, thank you very much for joining us. I definitely appreciate it. If you have any comments, please leave them below. Otherwise, do me a favor, check out our other social media platforms like Instagram, Facebook, and TikTok. We have a lot of information on there, whether you're a homeowner, home buyer, home seller, doesn't matter. We have a lot of tips and tricks on there for you for helpful tips and tricks. Otherwise, guys, have a great day, and I will see you on Thursday tomorrow.